Buying your first home, refinancing, improving your credit score, buying an investment property, or even home design tips. We got you covered.
Hello and welcome to Mortgage Matters, a show where we talk about home buying, refinancing, and mortgage tips with Shashank Shekhar, the CEO of Arcus Lending. Welcome, Shashank.
Thanks, Ritika.
Shashank, in the previous episodes, we've talked about home buying and we've talked about low down payment options. So what are some of the low down payment options that you recommend to the viewers, as down payment has been a most important challenge that the viewers or the consumers face?
That's right. You hit the nail on the head. That's probably the biggest challenge. Market research clearly proves that not just for first-time home buyers, but even for move-up buyers, down payment seems to be the biggest challenge. And the good news is that there are several loan options where they do not need to bring in 20% down payment, which seems to be the usual misconception among home buyers, is that you absolutely need to have 20% down payment, or either you won't get a loan or you'll have to pay mortgage insurance. And there are loan programs which are as low as 0% down. There are some rural areas in the US that qualify to buy a home without any down payment at all. So those are called 0% down payment loans because you don't have to pay anything to get a loan like that. From there to conforming loans, which are as low as 3% down payment. So say if you're buying a $400,000 property, you can put $12,000 down and can buy something like that. Even in high-cost counties like, say, New York, New Jersey, California, coastal states, there are options to buy homes at 5% down payment if you're buying within the conforming loan limit, or FHA at 3.5% down payment. And I remember in one of the earlier shows, we briefly even talked about an 80-10-10 kind of a loan where you can buy homes even up to about $1.8, $1.9 million homes, again, in high-priced areas like California, for as little as 10% down payment. So as you can see that even though it is a big challenge for home buyers when it comes to down payment, there are several options all the way from 0% to 10% down where they can buy a home with so little down payment and don't even have to bother about paying mortgage insurance in most cases.
And when it comes to ARM and fixed interest rate loan, which one do you recommend to the buyers?
So it is a tricky question in the sense that a lot of it depends on the person itself, the people who are buying a home or even refinancing. The ARM stands, of course, for adjustable rate mortgage. What that means, just to clarify it to the viewers, is that the interest rate is fixed for a certain number of time. It's usually 3, 5, 7, or 10 years, and then becomes adjustable after that. Those are 30-year loans, just the interest rate is not fixed for the entire 30-year period. Fixed interest rate loan on the other side have interest rate fixed for the entire tenor of the loan. So if you're taking a 30-year loan, your interest rate will remain fixed for the entire 30 years. And when it comes to deciding between an ARM and a fixed rate, one of the most important things that a home buyer or homeowner needs to look at is for how long they are going to stay in the home and how long they are going to keep the loan for. So if they're buying a home where they plan to stay for, say, 15, 20, 30 years, they're like, this is my last home that I'm buying, I want to live here forever. And if the interest rates are low, then maybe taking a 30-year fixed makes more sense.
Yeah.
Because then they can take a low interest rate and don't ever have to bother about refinancing. They can just keep the same rate for the entire tenor of the loan. But a lot of first-time home buyers buy home for 5, 7, 10 years with the thought that they will probably move into something bigger after they have more income or if they have kids. And there, maybe adjustable rate mortgage makes more sense because the interest rates are fixed for 7 or 10 years, which is around the period they want to keep the home for. And then after that, they anyway plan to either sell the home or move out of the home. So why pay for a 30-year fixed mortgage when you can get an adjustable rate? But really, at the end of the day, I strongly advise that they should check with their loan consultant and figure out what their goals are, where the interest rates are, and what makes more sense. But broadly, I think that's what my answer would be.
So when it comes to the term, so which term should they go for? Should they go for a longer term like 30 years, or should they go for a shorter term like 15 to 20 years?
That's right. So when it comes to loan options, typically you have a 10-year loan, a 15-year loan, a 20, 25, 30. There are some other variations, but that's what most of the people would borrow one of those terms. 30-year term is the most popular in the US. Probably 60-70% of the homeowners or home buyers prefer to take it because the payments are the lowest. The longer you are on the term, the lower your payment is. But the longer you are on term, the more interest you pay on the mortgage because you're borrowing from a lender for a very, very long period of time. So it makes sense to take as short a loan as possible if you're trying to pay off your loan fast and if you're trying to keep your interest cost low. So someone would rather take a 10-year loan versus a 30-year loan, but not everyone can do that. Not everyone can afford to make a payment that high, and not everyone can qualify for a 10-year fixed loan. Because with the higher payments, you need to have a higher income to qualify for that kind of a payment. So while it's recommended that you take a loan as short a term as possible, it's something that you have to see how much you qualify for and if you're comfortable making that payment. The other problem with going with a short term is that you are now forced to make that bigger payment. We talked about the fact that you can still pay off your mortgage faster by making maybe an additional payment towards the principal.
Yeah.
So you can still take a 30-year loan, make some additional payments on the principal, and pay off the loan faster. But in that case, you're not forced to make a bigger payment. If you don't get that bonus a certain year, you don't have to make that extra payment. But if you take a 10-year loan or a 15-year loan, then you're bound to make that extra payment. And sometimes when people lose job for a few months or go through financial crisis, then they struggle to make that short-term payment. So in essence, it's great to have as short a loan as possible, but you need to be extremely comfortable with your financial situation that you will be able to make that payment even if there are some minor crisis that comes up.
Well, on that note, we'll take a quick break, and after the break, we'll continue our conversation on mortgage matters. Welcome back. You're watching Mortgage Matters, and we're in conversation with Shashank Shekhar, the CEO of Arcus Lending, and we're talking about home buying, refinancing, and mortgage matters. So, Shashank, we were talking about home buying. So when it comes to home buying, what does it take for one to find the perfect house? What should they look into?
I'm smiling because it never is a perfect home, or it rarely is a perfect home. I'll give you my example. We were thinking of buying a home just a couple of years after we came to the US. Our budget was about $600,000 in Bay Area, which wasn't much. And we were looking at homes. And with everything that we looked, we thought if only our budget was $100,000 more, we would have found the perfect home that we were looking for. And of course, we didn't have an extra $100,000. Then a few years later, we were looking for our second home, a move-up home, and then our budget was about $850,000. And we're looking at homes, and we're like, if only our budget was about $950, $1 million, we would have found the perfect home that we were looking for. And then recently, we bought another home, and then our budget was much higher than that. But it was, again, the same thing. It happens every single time. I've seen that 3 times in terms of home buying. So what I'm trying to arrive at is that it's very difficult to find the perfect home. So what you're looking at when it comes to home buying is that you need to get a little realistic. You need to have a must-have list and a good-to-have list. Must-have lists are something which is you can't compromise on. If you want to live in a single-family home because you need a big backyard, because you have a couple of kids who need place to play in, then that's something probably you can compromise on. You need to send your kids to good school, you need to find a home in, say, good school district that maybe you can compromise on. Maybe you need 3 bedrooms, you cannot live in a 2-bedroom. These are things you can compromise on. So things like those which are your must-have list. Like if I don't find a home like that, then I can't buy a home because it does not meet the need of me or my family. That's what we call a must-have list. And then you have, and it's good to have list. Like if you find a home in a good neighborhood with a good school district, with a 3-bedroom, with a large backyard, all that I need, I would ideally want to have a remodeled kitchen. Or I would ideally want to have a newly built home. I would ideally want to have, say, 2 stories and not 1 story. These are the kind of things that you can put on your it's good to have list.
Yeah.
If I get it, great. If I don't get it, it's okay. A lot of time people make the mistake of what you just mentioned, trying to find the perfect home, and then either they don't find it, they keep looking at it for several months, or they get disappointed with this entire process. As in imagine that you are putting in the most money that you have ever had or ever saved into a home that's your first home or second home, and you're trying to find that perfect home, and you end up with a buyer remorse. Like, oh, I put in all this money and I still could not buy a home that I really, really like. That's something that you should not have. And that's why setting that expectations internally between you and your spouse, if two people are buying, or yourself if there's just one person is buying, that I will not find everything that I'm looking for in a house. If you go with that, if you work with a real estate agent trying to identify what your must-have list and good-to-have list is, then you'll be happy when you buy it. Emotionally, you will feel nice that you bought a home that you really like and it meets all the requirements that you initially set out for.
So what are the different type of properties that they have? And are there any challenges in getting a loan for one compared to the other one?
There are actually challenges. Different property types are treated differently when it comes to home buying. So broadly, there are 3 or 4 different kinds of properties. There are single-family homes. Of course, those homes are standalone homes, typically with a backyard, small or large. Then you have townhomes, and townhomes or townhouses as they are called. They're usually double-story or 3-story buildings, and you don't share the ceiling or the floor with someone. It's your house, but you will usually share the wall with someone else, and that's why it's called townhomes. And then there are condos, which are like apartments, and condos are where you would, again, depending on which floor you are, you could be sharing either the floor or the ceiling with somebody else, just like you would do in apartments in most cases. And then there are multi-unit properties. There are what we call 2 to 4 units, meaning those are kind of single-family homes, but there are 2 or 3 or 4 units put together. So two or 3 or 4 different families can typically stay in that house because they are all standalone units. And those are called multi-unit properties. Now, when it comes to financing, which is what you asked, saying that are there challenges with some of these properties? I wouldn't call them challenges in the sense that you cannot get financing for those properties, but challenges in the sense that we as lenders treat those properties differently. For example, condos. If you buy condos, then you should be prepared to pay higher interest rate on condos. Condos, when the crisis of 2008 happened, Fannie Mae, which is the largest government agency, figured out that people who live in condos have higher delinquency rates, meaning the default on their mortgage is more than, say, single-family or townhomes. So because of that, they increased their interest rate a little bit on that. So people who buy condos should be prepared to pay slightly higher interest rate. Same with multi-unit properties, like 2 to 4 units. 2 to 4 units, typically people live in one of the units and then they rent out the other units. And any rented property are considered more risky for a lender compared to just a single family home where you are living. So these kind of properties, either be willing to pay higher down payment or be willing to pay higher interest rate, or both. And these are the things you should know in advance when you're having that consultation for your pre-approval with your loan officer, so that you don't get a sticker shock much later on when you have already found a property, you have already made an offer, only to realize you'll have to pay higher interest rate for that.
And what about a newly built property compared to a pre-existing one? Which one offers a better value?
So it all depends on personal choices and the kind of options that's available. In some markets, there is just not enough land to build a lot of new properties. Again, if you look at coastal states, a lot of coastal states do not build a lot of new properties because they are busy towns, busy metropolis area. And those kind of places, you actually you can take out the pre-existing home out of equation. Because if you do that, then you'll be left with very little buying option on that. So what you need to look at is that on whether you're buying pre-existing or newly built home, see what is the condition of the property, not how old is the property. Even properties as old as 60, 70 years old could be in a perfect condition because they recently got remodeled. And if it's not in a perfect condition, then figure out how much would it take to make it perfect and factor that into your budget. So if your budget is $250,000, then buy a property which is not in a very good condition but only worth $220,000. And then you can take that $30,000 extra and use that towards remodeling the property.
Well, viewers, we'll take a break here, but after the break, Mortgage Matters will continue. Welcome back. You're watching Mortgage Matters, and we're in conversation with Shashank Shekhar, the CEO of Arcus Lending. So Shashank, now we have to go to some audience questions that they have. We have first question by Srini. He emailed us saying that he started a S Corp recently, and is he considered self-employed or wage earner?
So that's tricky. If you were to ask a CPA or an accountant, most of them would say that if you own S Corp and you pay yourself a salary, then some of the IRS codes will treat you like a salaried person because you're giving yourself a salary from the company that you own. Unfortunately for lending, we don't consider you as a salaried person. So Srini, in our case, will be considered a self-employed because he owns S corporation that he owned, and he's paying himself. So in pretty much all lending guidelines that we have, we consider them as self-employed. What that means is that if you're considered self-employed, then you need to have 2 years of tax returns for the company that he owns. And we average income over the last 2 years for what he has earned. It really doesn't matter how much he has paid himself at salary because that's something we don't look at. What we look at is that whatever salary he paid himself plus the profit that the company made, that's what we consider the total income for Srini. And then we'll look at his 2 years tax returns, as I said, the company tax returns that he files. We'll average it, and that's what we'll consider the income. One tricky part to that is that if he started his S Corp, say, only about a year back or a year and a half back, I don't know if he mentioned that in the email, but if he did that, then he would not qualify for the loan because as a self-employed person, we average 2 years, we absolutely average 2 years of income. So if he only has had the company for a year and a half, then he will have to wait it out.
Yeah, he said recently.
Recently,
so, yeah.
okay, so yeah, then even if it's a very high income producing company, he won't be able to qualify for the loan. What he can do, however, is that I don't know what the structure of the S Corp is, but he can go back to a regular W-2 pay stub kind of a job, actually get a pay stub from a company that he used to work before, if he can go back to the same company, or work for a new company, and then he'll be considered a wage earner, and then he should be able to qualify if everything else looks good on the loan.
All right. Next, we have the question by Shweta. She posted on our Facebook page that she recently moved to a 1099 position, but she has been in the same line of work for 10 years. Does that impact her loan qualification in any way?
So Shweta's case is very similar to Srini's in the sense that when you move to a 1099 position, that's usually you're given a Form 1099 when you're a contractor. You're not paid a pay stub, so you're paid a 1099 at the end of the year. And when you are a 1099, again, per the lending guidelines, I'm not quoting tax codes here because I'm not a CPA, but per the lending guidelines, we consider a 1099 employee as a self-employed employee. So not a self-employed employee, but a self-employed person. What that means is that all the same things that we talked about Srini applies to Shweta as well, which means that she needs to have 2 years of history of receiving 1099. And again, from her question, it seems as if she recently moved to 1099. Yeah. However, she was thinking that because she has been in the same line of work, looks like she has been doing the same thing before, and she is still doing the same thing. It's just that she was being paid a pay stub before, and now she gets a 1099.
1099, yeah.
So even though she has been in the same line of work for almost over a decade, it seems like, it will still not work when it comes to qualifying for a mortgage. And she can do the same thing which I advise Srini to do, which is if she can move back to the regular job position that she had, or she can convert her 1099 position to a pay stub W-2 kind of a position, and that way she can qualify for a loan if she has been in the same line of work for a very long time.
So for how long she has to stay in that W-2?
So that's a great question. So it's like, okay, I was W-2, now I'm 1099, I'm going back to W-2. Do I have to stay in that role for a certain period of time before I can apply to get a mortgage again? In most cases, lenders really don't require any seasoning on that at all because Shweta has been in the same line of work for a long time. So what we look at when we're looking at her file is that it's still a continuous employment. It's just that she moved from W-2 to 1099 and now back to W-2. So it could even be as short as maybe just a month back. Okay. She got her first couple of pay stubs, and we should be able to make that happen for her.
Wow. So we have the next question by Sharad. He emailed us saying that he runs a startup and does not have much income to show on his tax return. So he has high credit score and a large down payment, more than 50%. Oh. Can he qualify for a mortgage?
So I see a trend here with some problem viewers here. So what he's doing is that he's saying that he has very high down payment, more than 50%. Yeah. Seems his credit is fine. Everything else is okay with his loan qualification. The challenge is that he runs a startup and he has very little of income to show for in the tax returns. Yeah. Unfortunately, again, there are some things that you absolutely have to qualify on. Some people think that if they have compensating factor on one, they can compensate for that on the other, meaning he's saying that he has a very high down payment, he has a very high credit score. Can he compensate for the fact that he has very little income to show for? Unfortunately, no. There are separate guidelines and you need to qualify on each one of them. For example, qualifying on debt to income ratio is absolutely necessary for you to qualify for a loan. You need to show enough income where you will be able to support the mortgage payment that you're going to make, or other debts that you have, and property taxes and home insurance. So if you do not have enough income to show for, even if you have more than 50% down payment, that's not going to compensate for the fact that you don't have enough income. So in this case, unfortunately, he will have to probably keep working on his startup for some more time, show a higher income, and by the end of it, if he has enough income to support for it, then he can buy a home or find a cosigner or somebody else. Maybe his spouse works, I don't know, or his brother can cosign, somebody who can come up with that extra income that he needs to qualify for the loan.
Well, thank you, Shashank. That brings us to an end for today's episode of Mortgage Matters. If you have any questions, you can email us at mortgagematters@arcuslending.com, or you can post your questions on our Facebook page of Arcus Lending. Till next time, it's me, Kritika Aswani and Shashank Shekhar signing off. Keep watching Mortgage Matters.